Hello, I'm Sam Stovall, Chief Investment Strategist of Standard & Poor's Equity Research Services. I have a cold, so don't get too close to your computer screen. At this week's Investment Policy Committee meeting, we discussed the slowing of the economy and corporate earnings, as well as the rising risk of recession. The Federal Reserve's quarter-point rate cut on October 31st suggests to us that they believe the worst is yet to come. We think the weakest stretch is likely to be over the next 3 quarters, with year-over-year real GDP growth troughing at only 0.6% in the first quarter of 2008. Whether economic growth experiences a slowdown as we expect or turns into a recession depends on whether consumers continue to ignore energy and home prices, the current problems in financial markets extend the downturn beyond housing into other sectors, especially commercial construction, and if overseas economies continue to grow and purchase more U.S. goods. S&P thinks that overall economic data has yet to slow significantly enough to warrant a rate cut at the December meeting. We believe the Fed will likely wait until late January to cut rates again, as by then holiday sales should show a 3 to 3.5% year-over-year increase, which will be nearly half the rate seen last year. So there you have it. Our Investment Policy Committee worries about economic wildcards, in particular the health of the future of employment growth as indicated by the divergence of the payrolls and housing data, stubbornly strong oil prices and the likely upward pressure they will exert on inflationary pressures, and the wide gap in 2008 earnings forecasts as seen from the typically optimistic, analyst-driven bottom-up perspective or from the usually more conservative top-down or economically generated starting point. Right now, we are sticking with a soft landing scenario, but we freely admit that the risks of recession are rising. I'm Sam Stovall, and I'll talk with you next week.